What's happening, all? It is 6/9/2020, and interesting stuff has happened in the last few days. We had last week, of course, the jobs report came out that looked really way big swing, way different than what everybody anticipated. Had a major impact to the mortgage-backed securities market, as far as where money was flooding over to stocks. And we'll take a quick look at these charts real quick here. So we see here's where Friday took that and went well below the trend lines, below our support lines, but then crawled back. He gained some footing. And then as a result of yesterday getting some news that maybe those reports were wrong, that maybe it was miscalculated, because we're talking about a survey process here. And that survey process is definitely not perfect. And because of the imperfect process, now they're figuring out, wait a minute, maybe we were incorrect in some of this because of who's going back to work, who's not, who answered the phone on that survey saying, I'm anticipating to go back to work, but I'm off for other reasons, things like that. We also have the PPP plan that was paying payrolls, but not necessarily putting people to work. So there's a lot of different things that could have played part in those numbers not being 100% accurate. So mortgage bonds shook that off, came back into the trend line yesterday. Stayed literally, when you look at, I'm going to zoom in on this. This is the 3.5. You look at where it opened high right against resistance at the bottom of those trend lines and worked right back down to match pretty close to where we closed on Friday. But then look at us today. Today we're above those trend lines, staying within this pattern, interestingly enough. The Fed is going to be doing somewhere in the range about $4.5 billion in mortgage-backed securities today. So all those trading, the Fed buying into that, is keeping mortgage-backed securities within these channels. Now, I have been asked earlier today by a client asking me about some deals we just recently closed, saying, hey, what is the chance of us getting in even lower? When I'm at that low loan to value, 70% loan to value on these refinances, what's the chance of getting 3.5% on investment property? Well, the chance is there, but we'd have to drive a lot more capital into these bond pools. As you can see, we got out of the squeeze and now we're above these trend lines, but we're also staying within the same trading pattern. Well, we think about what's driving it right now. The Fed is the one driving this. Go back, we're actually going to have to open this up quite wide to take a look and see where the Fed jumped in. Back here, March 20th, and the Fed jumped in, started buying. Barry came in and told us all about how they got, hold the Fed, got them to back off of that and bring it into a channel so we don't, really completely destroy the industry with the refinancing, doing what it's doing to the servicing side. But, when we're seeing this, one of the main reasons we lost a lot here, from the understanding that I have, has to do with all those margin calls in the stock side, right? We talked about the banks, where the banks were, they don't take your money and just put it in the vault. They take it and put it to work out there when you have money on deposit. Well, they had that money on deposit out working in partially in the stock world. Well, if you're on margin at all, and those margin calls came in early March because of where things went with the stock market, we all saw that beating. Well, they had to start selling something to be able to pay those margin calls. So they sell assets with mortgage-backed securities. The Fed came in and brought it back. Federal Reserve came in, brought it back to where it was, and then flatlined it. Didn't keep it on its trend going down as far as rates with the mortgage-backed securities going up. It stopped this trend that was happening here and this big jump, and it flatlined it out. Now, possibly, I'm just spitballing here, that if they sold off assets to get their margin calls in order and get the stock part thing in order, now the stock has continued to go back on the rise. But then at the same time, there is anticipation. I see, other thought processes saying we could see all this, another round of beating on the stocks and then go way down again. But if it does, have those institutions that were here, that needed all that money for their margin calls, have they reorganized their holdings to where they're not going to be in that risky position later? Are they going to be able to take that extra capital that they would have had to allocate for that and put it back into mortgage-backed securities? Have they been able to gain back some of that in the stock market's rise and push it back over what they call flight to quality, I hear, which in reality is the cleanest dirty shirt in the laundry if you really want to get down to what's going on out there in the markets. Well, if they do that, with what the Fed's doing too, we could see it go back on that trend. Maybe I can't say whether or not we're going to jump back up, but if we do, then we might be able to see interest rates go on a downward run. But for how long? Yeah, we don't know. So those are the things I'm thinking that might have some sort of influence. I can't say for certain because I don't know any of those positions out there. I'm just spitballing what could be. So a little bit of information for those real estate investors. Housing Wire article had indicated that 26.1% of renters surveyed with leases expiring in the next 6 months say that they're planning to renew. There's 35.9 are saying they're not likely to renew, and 38 are somewhat they're not sure at the moment where they're at. So we do know at least a third of people saying, I'm going to renew my lease. Now, another interesting tidbit is that anybody who's paying more than $1,750 a month are least likely to renew, interestingly enough. And they said that, when you think about that number, $1,750 a month, the real estate investors here that I work with, we're not dealing in those ranges very often. We're looking more like that $1,000 a month, $1,200 a month, $800, $700. So maybe that's part of that third that's renewing. So when you also think about these numbers of that survey, a third is saying they will renew, and a third not likely, and 38% not sure where they're at. Well, let's talk about that third who's not likely. Well, when we think about how many people are renting out there, look at some of these higher end markets, your coastal markets, the very expensive markets where it's very, very tough to buy. There's a lot of people out there that are paying the higher rent. That's a bigger part of the survey. When we're talking about the markets that we invest in as real estate investors, we may be part of that. And I don't have the numbers here. I'm spitballing here with this article. We may be part of that number that's likely to renew, because we have two different bits of data here that's showing that the likelihood of renewal for those with the lower rent, because of their housing affordability capability there. When you're talking about $1,700 a month payment, you could possibly finance a lot of house with that. When you're talking about rents in the 7s, 8, 900s, you're not talking about being able to buy, a property in those markets that would sustain a home. So when you're talking about these numbers, I'm thinking we as real estate investors in some of these more central markets, like the South and Midwest, might be the ones that are a little bit safer with that and seeing these renewals happening. That's just, my guess. I could be a little bit off on that. The Fed, again, putting in $4.5 billion today. We'll see how this all shakes out. But everything looks still very, very positive for the real estate investor. Yes, remember, there's still going to be some points being charged in there if you're putting 20% down. And if we ever see anything change out of that, we'll notify you here.